Let's be honest.
Let's be honest.
This bull run feels a little weird.
Weird. It is weird.
Crypto is supposed to waltz to a neat 4-year rhythm. Halving, hype, blow-off, blues. Instead, we have spot ETFs and corporate entities vacuuming up supply ahead of retail investors, meme coins mooning before blue chips, and the world's largest economy forming a strategic Bitcoin reserve. And this all makes it more difficult to figure out where exactly we are in this market cycle. And that's why in this video, we'll unpack the classic cycle, examine why this round looks a bit different, reveal who stands to win, and yes, we'll discuss whether the usual 4-year rhythm just flatlined. My name is Nick, and this is a video you cannot afford to miss. Before we start, a quick heads up. I'm not a financial advisor, and this isn't financial advice. We're just sharing information for education and entertainment, so always DYOR before investing. Now, to kick things off, it's worth doing a quick refresher of the concept of the classic 4-year cycle. So, Bitcoin's heartbeat is the halving, a hard-coded supply cut that fires once every 210,000 blocks. The 4 events so far in 2012, 16, 20, and 2024 have each sliced BTC issuance by half and, in doing so, throttled the steady stream of coins coming to the open market. Supply shrinks overnight while demand gradually rises in tandem, as many analysts and investors believe the imbalance is the spark that ignites the major leg up in the typical cycle. Reduced sell pressure from new supply lets price drift upward, and the sky is the limit. The theory states that as the market realizes a new scarcity regime is in force, a reflexive reaction occurs. A rising chart pulls in headlines, headlines pull in fresh capital, and the circular feedback loop sends prices upwards at an increasing rate. Historical performance underscores the potency. From halving to cycle peak following each of the first 3 halvings, Bitcoin rallied roughly 95 times, 30 times, and 8 times respectively, an eye-watering average that cements the number go up legend. During this stretch, crowd euphoria inflates valuation metrics such as the MVRV score, and this is an on-chain metric used to identify whether BTC is over or undervalued relative to its fair value. A reading above 7 has accompanied every major top to date, though in mid-2025 the gauge is still well below that danger zone. And typically, momentum outruns fundamentals, ushering in the short, spectacular climax of a blow-off top. Minor profitability spikes, long-term holders transfer billions in dormant coins to exchanges, and leverage ratios reach cartoonish levels just before liquidity evaporates. When bids disappear, price collapses in a matter of weeks, marking the cycle's zenith. The hangover of the classic 4-year cycle is something which, dare I say, every one of us is familiar. Drawdowns of 70 to 90% across the board, which purge excesses. Hash rate then stalls, and skeptics resurface to declare Bitcoin dead for the umpteenth time. On-chain, realized capitalization compresses as capitulation ensues. Off-chain, this has often coincided with monetary conditions tightening, amplifying the pain. The market then grinds sideways until we begin to approach the next halving, when a rally begins in anticipation of the cadence restarting. 4 interlocking forces: issuance maths, minor economics, reflexive psychology, and macro liquidity have all kept this metronome regular for more than a decade. Yet, as we hinted at in the introduction, this cycle seems to be departing slightly from that script. Before we discuss how and why that is, give this video a like if you're enjoying it so far, and don't forget to subscribe and ping the notification bell as well so YouTube can give you a bell as well when we release another upload. Back to the video. Now, the first and most obvious departure from the prior bull run is the source of Bitcoin demand. In the past, retail traders and a smattering of crypto-native funds drove the upside. This time, 2 deep-pocketed buyer classes are hoovering up almost all of the coins on autopilot. US spot Bitcoin ETFs launched around 18 months ago already custody around $135 billion in BTC. And what's more, according to a joint report from Glassnode and Mania Group, the bulk of those positions are unhedged, long-only mandates rather than fast money swing trades. To put this into context a bit, the largest spot Bitcoin ETF, the BlackRock iShares Bitcoin Trust, currently holds about 692,000 BTC, and that's equal to around 3.3% of the 21 million Bitcoin that will ever be in existence. Right behind the ETFs come the corporate treasuries. Crypto's favorite technology firm, Strategy, has become a Bitcoin vacuum cleaner, with its current stash sitting at 592,345 BTC, or around $64 billion at the time of making this video. And chances are it'll be higher by the time you watch it. And you may have noticed that Strategy kicked off a bit of a trend, with many more companies following the Bitcoin treasury approach. In total, 126 publicly traded companies now control just under 4% of the Bitcoin supply, worth around $89 billion. And that makes treasury desks the second largest structural sink after the ETFs, a role miners once used to play in reverse by adding supply. And this relentless cold storage migration has coincided with an environment that, paradoxically, feels a bit sedated. Realized volatility on 3-month window is sitting below 50%, remarkably low for a bull market and far beneath the 80 to 100% prints we saw in 2017 and 2021. Glassnode attributes this calm to a heavier institutional mix and to longer holding periods that dampen reflexive whiplash. Even short news-driven sell-offs have struggled to push BTC outside of the 100 to 110k band of late. While Bitcoin supply tightens at the top, activity is exploding further down the crypto ecosystem. Ethereum Layer 2 rollups such as Base now consistently process around 11 times more transactions per second than Ethereum itself. Improved UX, modular data availability layers, account abstraction wallets, and near-zero fee bridges mean newcomers can interact without even touching L1 gas prices at all, a dynamic that simply did not exist in earlier cycles. The retail zeitgeist has also shifted. In prior cycles, once Bitcoin topped, leading altcoins had their big rally, which would then be followed by altcoin mania as crypto traders ventured further out along the crypto risk curve to projects that had little or nothing to do with crypto utility. In 2024 to 2025, however, meme coins front-ran altcoin majors. On Solana, 54% of May's DEX volume came from meme coin pairs. Back in February, this figure reached over 70%, something historically unprecedented. This inversion, high beta froth preceding any major blue-chip momentum, suggests the speculative end of the market is behaving much differently this time around. Whatever the reason behind it, one can't deny that meme coin mania has been a core feature of the last year or so. And finally, the policy backdrop looks less binary than the harsh crackdown following 2021. The United States has just cleared a federal stablecoin bill through the Senate, a landmark that moves us closer to the regulated path for dollar-backed tokens. A pro-crypto SEC has meanwhile been dropping crypto cases left, right, and center. It appears most crypto operations in the US have a clear green light in comparison to the previous cycles that were marked by constant state of existential dread. Combined with pro-crypto overtures from the Trump administration and MiCA's rollout in Europe, regulation is becoming a clear map of green and red lights, certainly leaning in favor of the industry overall, rather than the on-off switch that had the industry constantly second-guessing its fate in the past. Put together, 2025's weirdness is structural. Supply is trapped in ETF vaults and corporate treasuries. Trading activity has migrated to cheaper rails. Retail speculation has reorganized around memes. And volatility is oddly tame, and the rulebook is being rewritten in real time. The old 4-year step waltz still echoes in the background, but the dances have changed, the tempo is slower, and the floor itself has expanded. Thankfully, you can still make mad money in these market conditions, and there's a simple way to maximize your gains. The Coin Bureau Deals page. That's where you'll find sign-up bonuses of up to $100,000 on the best exchanges around, as well as 50% off trading fees and 75% cashbacks on deposits on said exchanges. These deals are only available to Coin Bureau viewers and they won't be around for long, so take advantage of them ASAP using the link down below or scanning this QR code. Back to the video. But how did this all come about right now? Why has this institutional wall of money appeared now? Well, of course, the institutional bullrun began when talk of the spot Bitcoin ETFs got serious in the first half of 2023. Despite rejections of the past, it quickly became clear that the big boys wanted a piece of the crypto action this time around, and spot ETFs were to be the main gateway. Prices soared as odds of ETF approval kept rising, and sure enough, spot Bitcoin ETFs were approved and subsequently launched in January 2024. Keep in mind the timing of this rally was still pretty consistent with the traditional 4-year cycle. The bids flooded in for these spot ETFs, and BTC's price soared 70% higher in the weeks following their launch, ultimately forming a local top in March of that year. In September 2024, Bitcoin saw the beginning of its second major leg higher this cycle, when US monetary policy loosened its grip and the Federal Reserve delivered the first of what would become 3 consecutive rate cuts. Grayscale's monthly commentary noted that the very week of that initial cut, the FTSE Grayscale Crypto Sectors Index logged its largest return since March, signaling that cheaper dollars were already pushing out along the risk curve. When the Fed formally slowed quantitative tightening in March 2025, trimming Treasury roll-offs to $5 billion a month, investors and traders interpreted the gesture as a green light for still more risk. And of course, these liquidity tailwinds met a political tailwind when President Donald Trump won the presidential election a few months prior. Markets, particularly crypto, saw a massive leg up following confirmation of the crypto president's victory in November last year, ultimately leading to a new all-time high. Trump then went on to sign an executive order revoking several Biden-era enforcement priorities and set up the Presidential Working Group on Digital Assets. For the first time, US agencies were told to nurture rather than neuter crypto innovation. 2 months later, the administration crossed a symbolic Rubicon. An executive order issued in March this year created a strategic Bitcoin reserve inside the Treasury and required all forfeited BTC to be transferred there and, quote, not sold. Estimates put the initial trove at about 104,000 BTC, as analysts do expect the return of 94,000 BTC to Bitfinex. Either way, this instantly removes another chunk of float from circulation and signals to the world that Washington now treats Bitcoin like digital gold. Congress is now on the verge of supplying the final piece of the puzzle through the Genius Act. The bill's one-to-one reserve mandate would give stablecoin issuers a clear federal charter and, just as importantly, tell traditional banks exactly how to participate. Put together, spot Bitcoin ETFs, corporate Bitcoin treasuries, some ease in monetary policy, a deregulatory blitz from the White House, and the creation of a US sovereign Bitcoin hoard have stretched the market's usual halving tempo into something broader. More than that, all of these factors have made this cycle much more Bitcoin-centric. While there have been opportunities for big runners in the altcoin space while Bitcoin rallied into six-figure territory, the altcoin market looks very different from 2017 or 2021. As we noted earlier, meme coins are now a core feature of altcoin trading. Meme coins have consistently accounted for a majority of all Solana DEX volume since Q2 2024, an inversion of past cycles where the major speculative froth typically arrived only after Bitcoin peaked. If we are indeed in a Bitcoin-centric cycle driven by institutions, while altcoins generally lag behind, you may be wondering, where is retail in all of this? As it so happens, we actually covered this in a separate video, which you can watch right over here. Now, you don't need us to tell you that altcoins are moving much differently than they did in previous cycles. However, this then begs the question, has the typical 4-year cycle flatlined? Ever since Bitcoin's first halving in 2012, investors have treated the 4-year cadence as gospel. Supply shock, reflexive melt-up, crash, and then recovery. Yet, the evidence piling up in 2024 to 2025 is awkward for that tidy script. Volatility is crushed, drawdowns for Bitcoin are shallow but oddly prolonged, and price has spent months meandering around without a clear expansion to one direction or the other. Elsewhere in the crypto market, altcoins are also failing to showcase the typical explosive moves we are used to. Instead, it seems we are continually faced with the odd spike here and there, followed by a slow bleed as prices can't manage several big legs up. Bitcoin's corrections this cycle have maxed out at minus 30%, rather than the routine 50 to 70% drawdowns seen in previous cycles. This is enough to shake out weak hands, but far too gentle to reset valuations in a single waterfall. So, what's changed? Well, the cycle's once violent market movements have been muffled by dollar-cost averaging leviathans. US spot Bitcoin ETF issuers continue to soak up BTC, seemingly oblivious to price spikes. Corporate treasuries such as Strategy add predictable bids, and the US Treasury itself will lock away an estimated 104,000 BTC. This all smoothens out volatility in the market. In fact, as a result of these factors, Bitwise CIO Matt Hogan argues that macro catalysts, not block-reward math supply shocks, now set the tempo, and that, quote, the traditional 4-year cycle is over in crypto. Miners, once the involuntary sellers who punctuated every cycle, are also less binary. With sophisticated hedging desks at firms, they are pre-selling hash rates months ahead via forward markets, turning the halving from a cliff into a manageable step-down. Glassnode's research shows miner balances shrinking only marginally since April's reward cut, a far cry from the capitulation waves that followed earlier halvings. Even the market's riskier corners are divorcing themselves from the cycle. Memecoin mania suggests that retail speculation is now driven less by tech or Bitcoin dominance and more by low-friction wallets, social media virality, or just some good old-fashioned cabals looking to shill a token they launched in 2 seconds through a memecoin launchpad. Of course, none of this proves that the drumbeat is dead, only that its rhythm is changing. ETFs cannot absorb coins forever, miners still face rising energy costs, and reflexive price action can still ignite when the necessary conditions do induce it. Yet, if the cycle once mimicked a consistent metronome, maybe it now resembles jazz, familiar motifs but unexpected pauses, and crescendos that arrive on their own schedule. Crypto investors who cling to the old sheet music risk missing the tune altogether. 4-year cycle or not, Bitcoin is stealing the show this cycle and cementing itself as the institutionally accepted crypto asset. But then, how should we approach the altcoin market in an institutionally driven cycle? We are not under any illusions here. We believe that there will continue to be a memecoin season in the future. The temptation of trying to catch a 100x runner will not leave the mind of retail crypto traders. However, in the context of an institutionally driven cycle, other sectors do stand to benefit. With this backdrop, one altcoin sector in particular stands out: real-world assets, or RWAs. Asset tokenization has sprinted from proof of concept to headline act. Public blockchains now host roughly $24 billion in tokenized treasuries, credit, and commodities, double what it was last year. And the curve is still climbing. BlackRock's Biddle Fund alone commands $2.9 billion and can now be posted as collateral on major crypto venues, proof that Wall Street's rails and DeFi's pipes are finally meshing. In parallel, stablecoin issuers already need over $200 billion in T-bills to back their tokens, so any further increase in stablecoin supply translates into nearly the same amount of treasury demand. Hard data also backs this narrative. CoinGecko calculates that the tokenized treasury sector has grown 545% since the start of 2024, outpacing every other RWA vertical. Projects that pipe real yield from sovereign debt, money market funds, or revenue share in real estate into token form therefore look primed to absorb the bulk of institutional capital that may venture out along the crypto risk curve away from Bitcoin. Yet, yield alone won't be enough. If crypto has truly arrived as an asset class, projects should also show real product usage and some profitable cash flows. DeFi blue chip Aave clears that bar, hauling in $85 million in annualized protocol revenue and charging nearly $600 million in annualized fees across its money markets. Those numbers give allocators something meatier than potential TVL to underwrite, and they illustrate why seasoned investors increasingly demand audited revenues, not just tokenomic PDFs. The snag here, however, is saturation. Crypto now has many millions of tokens, while heavy unlock schedules and fragmented liquidity keep raising the hurdle for newcomers. Many analysts believe that capital is clustering around selective winners with authentic product market fit and active users, while narrative-only coins face a swift culling. With that in mind, in a world of infinite tickers, missing the right horse because you ventured too far out the risk curve becomes an ever larger danger. That is why most investors choose to keep BTC as their portfolio's anchor. Bids from institutional investors, corporate treasuries, and even, potentially, a bid add into the US Strategic Reserve all focus on Bitcoin. Altcoins can offer greater returns than Bitcoin, but you better have a good reason to opt for something that doesn't have that structural bid. Now, while we have all established that this time around looks a little bit different to the typical 4-year cycle, we refrain from stating those dangerous words that this time is different. So, if we are in the final innings of a 4-year cycle before a bear market unfolds, a Bitcoin top is expected sometime between Q3 this year and Q1 2026. But how high might we go for that cycle top? At the time of making this video, total crypto market cap sits at $3.2 trillion, with Bitcoin commanding roughly 65% of that value and stablecoins a further 8%. Whether the coming months can add another couple of trillion, or several, hinges on the same forces that have sent Bitcoin into six-figure territory. A consistent institutional investor base, a White House bent on deregulation, and generally softer monetary policy. If stablecoin demand continues to grow while these factors maintain their positive push on crypto prices, the total crypto market cap could reach $5 trillion and beyond, still an expansion of 55% from here. And this would be roughly in line with analysts at JP Morgan, who see Bitcoin reaching $150,000 this year. However, there are certainly more bullish analysts out there, such as Standard Chartered, who think that Bitcoin will reach $200,000, a near 100% increase from current prices. Whichever branch the market takes, one warning endures. Attempting to time the top perfectly is seductive and winds up being costly more often than not. Keeping the 4-year cycle in mind can be helpful, but it is important to note that the game has indeed changed. Having Bitcoin as a portfolio's anchor seems to remain the core tenet of navigating these ever-evolving crypto markets, even more so in this Bitcoin-centric cycle. So, letting a few promising altcoins ride shotgun and treating everything else further out along the risk curve as a lottery ticket remains a reliable way to enjoy the view if the market does indeed climb toward $5 trillion and beyond, and to survive if it stalls out before then. Now, if you enjoyed that video, then don't forget to check out our latest one right over here. And if you're not subscribed to the channel yet, well, you can do that right over here. That's me, Nick, checking out for now. Thank you guys very much for watching, and I'll see you again soon.